Market changes can be fast and furious, leaving some investors and their portfolios struggling to keep up. How can you adapt to ever-changing market conditions? Well, a new fund called the Elm Market Navigator ETF aims to do the heavy lifting for investors. And here to explain more about it is Victor Hagani, CIO and founder of Elm Wealth. Hello, Victor.
Hello, thank you. Good to be here.
Oh, it's great to have you. So staying on top of fast-moving markets, it can be a challenge for investors. For example, external changes in the market or economy sometimes happen faster than an investor can react. What are the challenges facing investors, and what is Elm Wealth doing to help them address some of their concerns?
So, indeed, market conditions are changing all the time. Interest rates are going up and down, stocks are going up and down. And I think that most investors feel that having a dynamic and responsive asset allocation makes sense. The expected return and risk of the different asset classes is moving around, and our portfolios should reflect what those opportunities look like. Now, for most investors, it either takes too much time or it's hard to separate the signal from the noise in what's going on. And also there's a tax efficiency. People like to be buy and hold so they're not generating lots of capital gains over time as they rebalance their portfolio. And so what we've created or brought to market, it's a conversion of a fund that we had for investors since 2011. So it's got a longish track record of almost 14 years now. And it is a dynamic asset allocation ETF that uses low-cost ETFs as its building blocks, and it changes the asset allocation over time in line with changes in the expected return of different asset classes and their riskiness.
The Elm Market Navigator ETF, the ticker is Elm, simple ticker there, and I like the name because the name says it all. You guys are aiming for growth of capital by owning a portfolio of low-cost index ETFs. Although the fund uses index ETFs, Elm is still actively managed. What types of ETFs does Elm's portfolio own, and how does Elm dynamically allocate across these various funds?
So the ETFs that we own are mostly from the big and trusted providers. Vanguard is the sponsor of most of the ETFs that we use, but we're also using ETFs to fill in some of the gaps in other places from iShares, JP Morgan, State Street, et cetera. And so the average cost of the ETFs that we're using is about 5 basis points in our fund, in our ETF. And, when we started our business back in 2011, the cost of the ETFs we were using back then was probably like 12 basis points. So it's come down by more than half over these last 14 years. And maybe we'll even drift a little bit lower there. So we think fees are really important. The ETFs we use have low fees, and we ourselves charge low fees as well. The total fee, including the underlying ETFs of our fund, is 24 basis points, which is about the lowest of any of the independent asset allocation ETFs that are out there. Now, you also asked about, exactly how do we do this, how do we actually do the management in our ETF? And as I said, we increase allocations when the expected return of a particular equity market goes up relative to safe asset returns and decrease when it goes down. And also when the risk level of the market jumps, we reduce allocations by about a third. And when we're in a low risk environment, we increase allocations by about a third. So the amount that we're allocated to equities, global equities over time is varying as expected return and risk are changing. And what we feel is that this allows investors to keep a higher average exposure to equities. That if you know that you're going to do a buy and hold forever, you might be kind of conservative with how much equities you want to own. But if you know that somebody is watching and changing it, is going to try to protect you from cases where stocks are trading at huge multiples and maybe we get into a very high risk, volatile environment, that there's going to be some changes to the portfolio that will be protective in that environment. And I think that gives investors more confidence to have a higher average allocation to equities over time, which is what we're really hoping to deliver to investors.
Yeah, and a little peace of mind, of course, too.
How
do you see investors and advisors potentially using Elm inside their diversified investment portfolio?
Our DNA or our origins are as a wealth manager rather than an investment manager. And so for many of our clients, they're using our product, our ETF, or we also do separately managed accounts, but they're using our ETF as the main building block of their portfolio. Maybe it's the majority of their investments is just this investment in this global asset allocation ETF. For advisors, on the other hand, I think a lot of advisors find the conversation about changing asset allocation for their clients to be a tricky one because they're normally saying, let's take some chips off the table. This and this and this have done really well. That's going to involve realizing some capital gains for them. And it just could be a kind of difficult conversation about when do you reduce exposures? When do you buy when the market's gone down or risk levels have gone down? And by having a fraction of client portfolios in our ETF, you're getting this tax efficient and automatic asset allocation, tactical asset allocation tilt into your client portfolios that then you can have this conversation of, well, we've reduced your exposure because this ETF that we have in your portfolio has reduced exposure to US equities. How do you feel about that? Would you like to increase it? And then it's a much easier conversation. So we're talking to advisors who are finding it, interesting to think about having 10 or 20% of client portfolios in our ETF, which is really exciting. I think that people are realizing that, there's really no such thing as passive asset allocation, that, at the end of the day, asset allocation is always an active decision based on the expected return and risk of different asset classes. And, I think also investors, by and large, find what Jack Bogle said a long time ago, that the best investment strategy is the one you're going to stick with, is also a really important guidepost to investing, that doing something that's logical, transparent, diversified, low cost, is really the way to go. And we're super excited about our ETF. It's amazing that there's something like, $4 trillion of asset allocation mutual funds that people are invested in, target date funds, balance funds, $4 trillion. But the asset allocation ETF space is less than $10 billion. So we think the asset allocation ETF space has a huge growth opportunity ahead of it. It makes more sense to be in an ETF structure where you have the liquidity and you have the tax efficiency that you don't have in the mutual fund structure. But target date and balance funds came about in mutual fund space. And I think that we're going to see a lot of growth in the area. And that's what we're really excited to be part of. We're $450 million at the moment and growing. And, we're really excited about the opportunity, and the listing on the New York Stock Exchange is all very exciting. And we're very optimistic about the future.
It is exciting indeed. Congratulations to you. And yes, we have seen that just this monumental growth of ETFs on the NYSE. So you are right on target with that. Victor, thank you so much for joining us today on First Look ETF. We appreciate it.
Thank you, Stephanie. Yeah, that was great. Really appreciate it.